Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just an hour to go now until the closing bell, and stocks are mixed. The NASDAQ hovering just above the flat line. Well, let's welcome in now Jared Blickery joining us to break down the headlines. Jared, what are you seeing in the markets?
As you said, the markets are mixed, but if I show you what's going on today, you're going to say, well, that's a lot of chop. And this is the Dow down about 16 basis points or 75 points. As you see there, the NASDAQ just barely green, but it's been chopping around the unchanged. That's that dotted yellow line all day long. And the S&P 500, throw that in the same bucket. So some different results of where they are right now, but there hasn't been a lot going on. I do want to show you the Russell 2000 though, because that is up almost 1%. So we have seen some movement in pockets, but here's another small cap index, the S&P 600, which is actually down. So what's the difference? S&P 600 only allows profitable companies. Russell 2000 allows unprofitable companies. So I guess you could infer that unprofitable small caps are the trade du jour, but this is looking like holiday trading. I wouldn't make too much of it. Let's take a look at the VIX here real quickly. We can see that has come down just a little bit below 16. Not a lot happening on that front, but I do want to show you what's going on in the bond market. We do have some activity there. This is the 13-week T-bill yield, and this is what happens on the short end of the curve. This closely tracks what the Fed is doing, and we can see that is down 2 basis points today. It was at 3.75 just a few days ago, and it has dropped to 3.61. That's a difference of 14 basis points. Doesn't sound like a lot, but it is kind of a big deal because this is well below what the Fed is targeting for its short-term interest rates. So this is traders front-running in the bond market a Fed cut next week, and so that is getting baked in pretty solidly. So I think what everybody's going to be looking for next Wednesday, definitely going to be focused on what Powell says, not necessarily what the FOMC officially releases at 2 p.m. Eastern. So that was the short end of the curve. Look at the long end. That's actually been moving up. That's up 5 basis points today. So you could say the yield curve is expanding. We have short-term rates going down, long-term rates going up. Interesting situation there. Here's a 30-year, pretty closely tracking what the 10-year is doing. That's up to 4.77%. Meanwhile, the U.S. dollar index not doing a whole lot over these 10 days. Today, it is just barely positive. It's chopping around quite a bit too. So I'm going to move on to the sector action. That's where we see industrials up 0.4%. That's XLI's in the lead there. Communication services, tech, and energy. That rounds out the green performers here. Also throw financials in. They're trying to turn green as well. Those are the outperformers from the S&P 500. Healthcare trading the worst to the downside. That's down almost 1%, followed by materials. Excuse me, staples, consumer discretionary, and the list goes on there. Briefly show you what's going on with the NASDAQ. Meta up 3.5%. So is Nvidia up 1 3/4. Tesla up 2/3%. Not a lot of big outsized green action. We're seeing a lot of downside action in some of the chip stocks, so I will show you that board right now. In semiconductor land, we went over Nvidia, Broadcom basically flat, but Micron down 3%, Intel down 7%. We got some trades to the upside. Lumentum up about 8, Western Digital up 3, but for the most part, semiconductors under pressure. Meanwhile, software is taking a different tack. We got Oracle kind of leading things along with Salesforce, each of those trading 3% to the upside. Looks like Snowflake is down 11%, but this is kind of a reversal of what we've seen recently where semiconductors were doing well and software was the laggard. I'm going to finish this off because we were talking about unprofitable small caps. Why not look at meme stocks? And here we're seeing an interesting board. We can see about 2/3 are in the green right now, especially some of the larger issues there, but also quite a mix of the smaller ones as well. So indeed, it looks like just some random risk on and some very small names today making the headlines.
All right, thank you, Jared. Appreciate it. Well, big tech stocks have traded mixed the last few months, with Google going from a laggard to the front of the pack. Meanwhile, Oracle, Meta, Microsoft, which started the year leading, have been falling off as Nvidia basically moves sideways. This comes as investors have shifted their views around the potential winners and losers in the AI race. Here with his take on these AI stocks, we've got Jed Ellerbroek, Argent Capital Management Portfolio Manager. Jed, it is great to see you. So let's start right there, because you know, Jed, you say a lot of AI skepticism right now, but we see no justification for this. Walk me through that, Jed. No justification.
Yeah, you're right. A lot of skepticism in markets today. Nvidia 15% off its highs. Microsoft has been down lately. Meta's been down quite a bit since its earnings release. So there's skepticism and a little bit of pessimism creeping into markets related to the big tech stocks. But the underlying demand trends remain exceptionally strong. Just looking at earnings from this week, Marvell, really good outlook, stock was up. Credo, a smaller semiconductor component company, really strong earnings, stock was up double digits. NVIDIA's earnings and guidance, 2 weeks ago now, were outstanding. And I think we're going to see really good results from Broadcom next Thursday afternoon as well.
What about this question I hear some folks ask you? They say their question is just about this historic data center build out. And their concern is, could we be overbuilding?
Yeah.
What do you say to that?
Yeah. I think the risky scenario for investors is comparing it to the cloud build out, for example. We've been building out cloud services, businesses moving from on-premises to the cloud for the last 20 years now. There have been 5 true cycles in that 20 years. But we are now 4 years into this AI data center build out without a single downtick. And so investors are nervous about that. It's unprecedented. And I think the big difference is consumers and businesses have been adopting AI tools faster than any other technology that's been introduced before. Faster than search, faster than social media, faster than the cloud. So demand has just remained stubbornly ahead of supply, even though the hyperscalers are building data centers as fast as they can. Just to put numbers on that, Microsoft is building 150 data centers this year. 3 or 4 years ago, they were only building 50. And the size of that 150 today is much bigger than the 50 a few years ago. So these companies are working hard to expand supply, but they have not yet been able to catch up to demand.
Is there a metric or a data point, Jed, you'd be listing for that would cause you concern?
Yeah. I think the biggest one that would concern us is if the utilization of America's data centers as a group ticked down and started to decline. Right now, it's actually at historic highs in the upper 90% range. But if that number starts to tick up, that would tell you that supply is caught up to demand, which means we don't need to build nearly as much.
Let's dig into some specific names here. NVIDIA, here, Jed, you point out trading at a lower valuation than much of the AI semiconductor group now. How come? Why is that?
Yeah, it's exactly what Jared mentioned earlier at the big board. He made such a great insight. He talked about low quality businesses outperforming higher quality businesses in small caps. That's been happening across markets, both US and international stocks, since the Liberation Day lows in early May. And we see that in semiconductors as well as almost all other sectors too. The lower quality, less profitable, higher debt, less consistent financial results over time, those have been the best performing stocks in the market, and the stalwarts, the stable ones, have actually lagged. NVIDIA is an example of that. Its valuation today is lower than most other semiconductor stocks, even though it's a far superior business. You also see it in retail, where Amazon stock is cheaper than Walmart today, even though Amazon's growing their revenues at double the rate of Walmart.
So you would chalk this as sort of broader market themes and trends. This is not, in your opinion, an NVIDIA-specific story.
Yeah, I think that's exactly right. I think it's market-wide trends. I think that we've seen the rise of retail trading. Robinhood is a perfect example. Robinhood's trading volumes are up, just dramatically over the last couple of years. And then on the other side, you've seen kind of traditional active equity institutional management trading volumes decline due to the rise of passive investing. So we're seeing retail, more speculative, more aggressive traders represent a greater amount of trading volumes, and I think that's reflected in the stock moves that we're talking about today.
Let's talk about Google for a second. I want to get your take on the Google TPU story. So we're referring to the company's custom AI chips.
Yeah.
What kind of competitive advantages you think that gives Google, Jed, in this AI race we're talking about? And I want your take just on the move, 90% in 6 months. Do you think that's getting overdone?
Yeah, let me answer your first question. Google's TPU chips, so 7th generation, they've been at it for over a decade. Amazon, meanwhile, is on just rolling out version 3 today, so Google's way ahead. It's a great chip. It's made specifically for the standards, the setup of Google's data centers. Now Google's going to start selling those externally. They're selling them externally to Apple. They're going to do it with Meta, probably others. Will the TPU work as well in other people's data centers as it does in Google's, which it was specifically built for? I think that's an unanswered question. Meta's obviously wants to try it out. It's a good chip. It's not as good as NVIDIA. It's not as flexible as NVIDIA, and flexibility matters because AI, the workloads, they're developing and changing so quickly. You don't want to invest in a piece of equipment that's going to last for 6 years only for it to be, obsolesced in just 1 or 2. So a few unanswered questions, but yeah, Google's got a wonderful chip. They've been working with Broadcom for a long time. Those two are partnering very, very successfully together.
I want to get you out here on this. I like this one. You say Amazon, you say, Jed, a stealth AI winner. How come? What are we all maybe underestimating, in your opinion, about their AI strategy?
Yeah, the talk on Amazon has been negative really all year related to 2 specific things. First half of the year, it was Trump's tariffs are going to make everybody at retail raise their prices, which means they're going to sell less and Amazon's going to be able to make less advertising money off of that. So the stock really lagged first half of the year. Then the second half of the year, the concern was AWS is not growing as fast as GCP and Azure. And that's a concern, and we think Amazon's losing market share. When in reality, what's happened is Amazon was just slower to start building data centers at a really fast pace a year and a half ago. Amazon got those demand signals that AI was real and huge a quarter or 2 after Microsoft and Google. But now, Amazon has those demand signals. They are catching up. They're rolling out capacity, and their revenues are going to accelerate. And we saw that in the third quarter. They reported an excellent earnings report. But now we've got this kind of AI skepticism building in, and the stock has struggled again. So it's just been kind of one stub toe after another for Amazon all year. But as I look out to next year, I see north of 20% growth from AWS. I see double-digit growth from retail, fastest growth rate in all of large cap US retail. So I expect the stock to do well and emerge as an AI winner.
Jed, great to have you on set.
Awesome.
Thank you, sir.
Thanks for having me.
Well, National Economic Council Director Kevin Hassett is widely viewed as President Trump's top pick for the next Fed chair, but some have doubts about his actions. Financial Times reporting that bond investors have told the Treasury they are concerned about Hassett's potential appointment. Yahoo Finance Fed correspondent Jennifer Schonberger joins us now. Jen, why are bond investors, Jen, maybe wary of a potential Hassett-led Fed?
Hey there, Josh. Yeah, there's been a fear swirling around bond markets that I've been hearing that if Hassett were indeed appointed to be the next Federal Reserve chair, he favors much lower interest rates, a view that President Trump shares and perhaps is counting on Hassett to follow through with if he is appointed as Fed chair. And that gives the bond market perhaps consternation because that ignites greater inflation risk. Now, for Hassett's part, he has said, in fact, he told me in an interview a couple weeks ago, he is very much a staunch supporter of Fed independence. He thinks that the Fed has made some decisions and taken some actions that have been viewed in a partisan light, and he wants to fix that if he were appointed Fed chair. And I would also just underscore that, look, the chair is just one member of the FOMC committee, and he will have to contend with 18 other viewpoints, 12 of which are voting members, and 4 of that 12 are rotating members each year from the Federal Reserve regional banks. And so there is a wide dispersion of views, and it is up to the chair to create consensus. And what we have seen this year is very abnormal given what's going on with the job market, given what's going on with inflation. And I would expect that dispersion to persist into 2026. It's up to the Fed chair to phone everybody on the committee, and that is typically what he will do ahead of the policy meeting to try to get a consensus on the direction of where they will go. Ultimately, of course, they make that decision during the 2-day policy meeting. But let's be clear, this is a committee decision, and it is something that Treasury Secretary Scott Bessent stressed again yesterday.
And Jen, while we got you, there are rumblings that if Hassett, did lead the Fed, maybe Trump could appoint Treasury Secretary Scott Bessent to lead the National Economic Council. You saw those headlines, Jen. Is that realistic in your opinion?
Look, anything's possible, Josh. It's very difficult to handicap what the president will actually decide, but I think that's a few steps too far because, one, we don't know for sure whether Hassett is going to be made the next Fed chair, and then what will be done to fill his slot if that indeed happens. I would just point to the fact that earlier this year, when we saw Fed Governor Adriana Kugler vacate her seat, we didn't expect that Stephen Myron would be the person appointed to fill out that 4 to 5 month stint that's left for that seat. And so we could be surprised here again. Again, nothing surprises me with this administration.
For sure. Headlines come fast and furious. Jen, thank you. Appreciate it. Coming up, I speak to the CEO of Beta Technologies about the company's first earnings release since its IPO. That is next on Market Domination. Beta Technologies posting its first earnings since going public in November. The aerospace and defense company reported a narrower loss than expected in revenue, topping expectations, and it comes just days after Beta announced a billion-dollar deal to build motors for Eve Air Mobility. Join me now, we got Beta Technologies CEO Kyle Clark. Kyle, it is great to see you. So let's dig right into this report, Kyle. I see revenues of about $8.9 million, see an operating loss of around $81 million. You highlight initial customer deliveries, certifications. What is the big takeaway for investors, Kyle, that you want investors to know from this report?
Yeah, I think the key takeaways are that we were able to generate organic revenue in our seeded products. So for example, with Eve, we were able to deliver the motors to get them into flight test, which of course then produces a large backlog opportunity in this particular case. So even though it's not meaningful revenues, they're revenues that are organic for our technological products in small volumes that lead to very large volumes. And that's consistent across all of the applications, General Dynamics, General Electric, and Embraer Eve.
You know, Kyle, I see you all posted a net loss of around $452 million this quarter. Help us understand, Kyle, what you think the path to break even could look like.
Yeah, I mean, just to be clear, of that $400 million of loss, most of that's non-cash because we were so successful in our IPO, we had to write down a large delta between what those last investors came in the private round. So, you know, that is non-indicative of our future performance. We actually have an incredibly tight relative to our peers cash burn position. We have I think the largest liquidity position in the industry. So between that, small cash burn and the fact that this facility and others are being financed by the XM Bank, it gives us a much longer runway than we had anticipated coming into the IPO. At this point in time. And we're taking the edge off of that cash burn with an increasing revenue contribution. And those revenues are coming in with positive contribution margin. And again, full transparency, they're small revenues relative to our business, but they are for organic products that we've developed that didn't exist a few years ago.
And Kyle, I want to dig into something else we mentioned there at the top. This other big headline, you're going to sell motors to Eve Air Mobility. How should investors think about that, Kyle, in terms of the market opportunity for you all, what it could mean in terms of revenue mix and margins? Walk us through it.
Yeah, for sure. I mean, we came into the third quarter with about $2.5 billion of backlog. We added just about $900 million to that backlog with aircraft sales, deposit-backed aircraft sales. And unforecast for us, because we actually thought it would take longer, we did not have included in our analyst guidance the ability to sell motors to our peers. But we successfully delivered to their prototypes and we were able to earn a production contract for their motors, which of course is quantified at about $1 billion. So what that means is that others are willing to pay for the technologies that we've developed, and not just random others. Embraer Eve is an incredibly credible aerospace and defense company that does rigorous diligence and has really good engineering. And for us to kind of sidestep an incumbent and walk in there with our technologies and earn that contract, I think it's a canary in the coal mine of what's happening elsewhere, where we've planted the seed of our propulsion, both in aerospace applications and in underwater applications. So for me, that high margin recurring revenue that's attached to the back of those motors is very valuable to us, and the technical validation is super valuable.
Kyle, correct me if I'm wrong, but I believe you said that commercialization is targeted for 2027, 2028. One, do I have that right? And two, Kyle, what are sort of the variables of that? You know, what could accelerate or delay that schedule?
Yeah, you know, you have that right. That is what I said before. In fact, when we started our roadshow, that's the schedule we're on. But the executive order that was announced last spring materialized into an RFP in September. And actually on the 11th, next week, we're submitting these applications to the Department of Transportation, which actually pulls in by about a year our launch into the market. So this administration, having kicked that door wide open to near-term applications, is drastically accelerating our entire market. And this facility that I'm in right now, along with our certification progress actually puts us in a leadership position to take advantage of that executive order and start deploying aircraft domestically. Remember, we already have operations up in Norway, down in New Zealand, to start deploying aircraft domestically as soon as next summer. So there's a big acceleration happening. We're pre-buying the materials, getting ourselves positioned to deploy those aircraft in anticipation of winning a large number of those EIPP programs, which is eVTOL Integration Pilot Program through the Department of Transportation.
More broadly, Kyle, remind us, how big is the market opportunity you all are targeting? And of course, you got competition. It's Joby, it's Archer. What makes you all different?
Yeah, the market sizing, the TAM is quite large and a little bit fuzzy, but it starts with like $1 trillion in our estimation over the next decade of shipped and backlog units. And the majority of that is made up with passenger urban air mobility, like 50% of it. But where we are starting to get to that large market is in cargo, medical, and logistics applications, where we're able to, with a very low barrier to entry, start deploying these aircraft into hospital to airport, hospital to hospital, or other UPS, Amazon, DHL, FedEx type applications, moving cargo and logistics overnight domestically before we get into jump over the city traffic with urban air mobility. So we see a huge market alongside those competitors that we highly respect and kind of run alongside right now. But our strategy is quite different in the stepwise market entry approach that we're getting a ton of traction on right now.
Final question, Kyle. As we head into the new year here in 2026, I'm just curious what is success for Beta in the next 12 months? How do you define that? What are the big milestones on your radar as the CEO?
Yeah, so right now it's certifying the first electric propulsion system ever with the FAA. That's going to happen in the first half of next year. It's winning the EIPP programs, and it's furthering our major defense applications. So if we do those three things in 2026, I think we'll have won.
Kyle, great to see you as always. Thank you, sir.
Thank you. Take care.
Coming up, we look into the latest changes in Meta's Metaverse unit. Don't go anywhere. Now time for some of today's trending tickers. We're looking at Apple, Pepsi, and Brown-Forman. Starting with Apple, BTIG analyst Jonathan Krinsky saying in a note that the stock is poised for a drop. We're seeing shares down nearly 2% today, and year to date, it's up just a modest 12%. Joining me now, we got Ali Canal. So this one, Ali, is actually a technical take from BTIG. This is their chartist weighing in. What he's pointing out is Apple now 25% above its 200-day moving average, long-term trend line. We think it once again is poised for a drop, especially, he says, as we look to January.
Yeah, so they cite a key momentum gauge, basically a measure of when a stock gets too high, and it signals that Apple may be overextended, and historically that's led to some give back as we move into January, like you said, Josh. Now, of course, when you look at the chart for Apple, when you really digest the story that we've been seeing over the past year, part of the run-up has been fueled by this renewed optimism around Apple's AI strategy. Now that includes everything from a leadership shakeup and buzz around a potential partnership with Google's Gemini, and that might power the next version of Siri. But even with all that excitement, BTIG basically saying that the near-term outlook could be stretched. We could be in for some bumpiness, some volatility. But if you're a believer of that long-term story, doesn't necessarily change the scope of that. And we'll see. I mean, Apple has really battled back from some of those lows that we saw to kick off the year. Again, mostly centered around the TBD factor of AI.
Yeah, I mean, Apple, for sure, Apple was one of those names like Google was out of favor earlier in the year, then boom, that stock's up about 40% in the past 6 months. What a move. All right, up next, Pepsi, close to signing a settlement agreement with activist investor Elliott Management. That's according to the Wall Street Journal. There are no details yet on what the deal could be, but it's expected to come soon. Remember, Elliott unveiled a $4 billion stake in PepsiCo back in September and has pushed that company to refranchise its bottling operations and divest from underperforming performers in its food business. What do you make of that, Allie?
Yeah, I mean, look, it makes sense considering Pepsi shares are down nearly 10% since the start of the year. You're seeing shares right now trading just around $146. That values the company at just over $200 billion. Like you said, Josh, Elliott has really been pushing Pepsi to revamp its strategy, lift that lagging share price. That includes calls to refranchise bottling, streamline operations, and rethink weaker parts of that business. The company is shaping up leadership, so that's perhaps the first sign. They're bringing in Walmart veteran Steve Schmidt as CFO. So, and Walmart, you know, it's a former Yahoo Finance Company of the Year. It's done very, very well, especially in the face of volatility, and we know the consumer is still stretched. So perhaps this is the start of a turnaround for Pepsi with the help of Elliott management, but of course, all that remains to be seen.
Yeah, journals saying an announcement could come soon, so stay tuned. Finally, Brown-Forman, the company behind brands like Jack Daniels, warning of a challenging landscape heading into 2026. The company forecasts low single-digit organic net sales and operating income declines. I was seeing basically reports in-line results for its fiscal Q2. Sounds like the street was really seen as kind of better than feared. I see Evercore cited here as saying, in the context of persistent category weakness, expectations were subdued heading into the print. They're in line on the name.
Yeah, and if you compare the year-over-year comps on these earnings, I mean, we're down across the board. Profit fell, still slightly ahead of expectations, like you said, largely met expectations, but down year-over-year. Revenue also down 6% year-over-year, and on an organic basis, sales fell 2%. So even though a better than feared report, it's still not great when we look ahead to the future. The company did cite the backdrop heading into fiscal 2026, that remains challenging. They pointed to consumer uncertainty, weaker barrel sales. They still expect low single-digit declines in organic revenue and operating income, with CapEx now trimmed to $110 million to $120 million. So we'll see about this name. I mean, look, Jack Daniels, Woodford Reserve, I can't say they're alcohols I personally drink. I know there's been a lot of changes when it comes to consumer preference on the alcohol space, and there also is this big movement, sober curious. A lot of younger folks are not drinking as much. So
did you say sober curious?
Yeah, that's a new movement. People are curious about the sober life on social media, especially like Gen Z.
Yeah, it's like that other word I hear, like choiceful.
Yeah. Well, like there was California sober, now we're sober curious. So yeah, I wonder what that means though for a lot of these alcohol brands, that they're going to have to adjust to the changing times.
Yeah, stock down about 20% this year. It's been rough. Thank you, Allie. Appreciate it. Meta stock is popping today. The company making a shift away from the metaverse. For more, we're bringing in Yahoo Finance tech editor. That would be Dan Howley. Dan.
That would be Dan Howley, Josh. Yeah, this is a move that Meta is making, according to sources that Yahoo Finance spoke to. They're not necessarily cutting funding overall from Meta's actual CapEx, but they're moving money from the metaverse to AI and smart glasses. And so it's basically, they're kind of saying, okay, metaverse, not so hot. Smart glasses, which have been selling well comparatively, and obviously AI, that's where we want to have all the funding go at this point. Not all of it, but more so. And so, I do think it is interesting. The metaverse was kind of supposed to be this big to-do, right? I mean, that's the reason why it's Meta, but it just doesn't seem to have panned out the way that it was originally pitched. And so now they're leaning heavily on AI. You don't really hear much about the metaverse from anyone, frankly. I mean, NVIDIA was also part of the metaverse. They called it the Omniverse. They do still talk about the Omniverse and digital twins, which they regularly talk about companies using to build factories and things along those lines. But that idea of a metaverse where we would all kind of get together as avatars and hang out, it doesn't seem to be panning out. The one place I will say that it appears to be doing well is Fortnite. I mean, people go into Fortnite and they'll have like voting events and concerts, all sorts of things like that.
Kinds of stuff going on.
It's not my bag. I'm not a Fortnite guy, but I guess that's where it's kind of going. So not so much the VR AR glasses. And look, Apple can't make the AR VR glasses work. I mean, how many people do you know have Vision Pro?
Not many.
Yeah, I know maybe one, and that's because I'm in tech. Writing. But yeah, I think that's, it seems as though that the industry is moving more towards these smart glasses. The Ray-Ban Metas are selling well for Meta, and they have the new Ray-Ban Meta displays. So I think that's the direction of the industry.
So do you think if you're trying to like read into Zuck's priorities or something like this, is it sort of like, okay, he's not giving up on the concept, he's not giving up on the glasses, but he's just saying, I'm really into this AI thing, and I gotta move some chips around.
Yeah,
is that how I should think about it?
I think that's kind of it. It's they're more interested in the glasses side of things and the AI side of things, and less on the full-on headset and getting into that kind of world where you exist in digital space. I do think that's where it is. And look, other companies are trying to get into the glasses space as well. Google and Samsung are teamed up. They're building their own glasses as well, using the Android XR platform that Google has launched alongside Samsung. Bloomberg's previously reported that Apple is trying to work on their own smart glasses. And so, that really, I think, is kind of when we'll start to see the area take off, if it does at all. I'm still skeptical on glasses. I literally have contact lenses. I put pieces of plastic on my eyeballs to not wear glasses. I gotta say, people get lasers shot into their head to not wear glasses. That's my skepticism, I think, in a nutshell. I wouldn't be putting plastic on my eyeballs if I didn't want, glasses on. So, maybe if they do something cooler, I'll do it. Yeah, it remains to be seen.
Let me get you out of here on this. In this great AI battle, as you look at Meta, and they got Llama, their LLM, how do you sort of compare and contrast them with Gemini and OpenAI?
Well, Meta's been having trouble getting their Llama behemoth, their big model out, right? They're absolutely whopper of a model, right? We just saw Claude launch Opus 4.5, Anthropic launch Claude Opus 4.5. Google has Gemini 3 Pro. OpenAI has GPT 5.1. It's falling slightly behind in that large model area, but they are still one of the leaders in open source. Llama is used by a number of companies at this point, just because it is open source. There's that access to it. Open weights is what it's called, and so I think they're still a leader there. They're obviously not going anywhere, and their own AI research is paying off for them as well, right? They're seeing it in their ads, they're seeing it in user retention, and so I think that they're seeing the benefit of AI for sure. The spending is still, as with any of these companies, the big question. How much more can you spend? What else do you need to spend? What else do you have to do? And what's the ultimate end game here, right? I mean, everybody talks about super intelligence, artificial general intelligence. Those are just like the foggiest of terms, right? Everybody has a different definition of that. They're all seemingly trying to get there. If you don't have a destination, right? Where are you going?
Yeah.
So I think that's one of the questions.
You got the glasses and the goggles. It's a start.
Yeah, no, I don't.
Dan, thank you, my friend. Appreciate it. Coming up, we get an analyst view on how to play the value retailer space. That's next on Market Domination.
Wall Street is increasingly focused on a new question. How is the global AI tab actually going to be paid? For a while, the big hyperscalers have been funding the build-out with tons of cash on hand, but reality and expectations, they are shifting now. More and more of that bill is likely to come from new debt, and Oracle is already there. It is borrowing to build AI data centers, and the cost to insure that debt has spiked. That insurance is called a credit default swap, or CDS, and that's what we are breaking down on today's Stocks in Translation. So let's start by breaking down the CDS, which you might remember from the global financial crisis. You can think of a credit default swap as a contract that protects an investor against a company not paying its debt. The buyer pays a yearly fee, like an insurance premium. If the company stops making payments on its debt, files for bankruptcy, or otherwise defaults, then the protection seller has to cover the agreed upon losses for the bondholder. To put it simply, it's just insurance on a corporate IOU. Now, how does this work in practice? Say an investor owns a company's bonds and wants protection. They go to a bank or a dealer and pay a fee each year to insure those bonds. If Oracle runs into serious trouble or ultimately defaults, that CDS contract pays out and helps make the holder of that bond whole. And this is key. When that yearly fee jumps, it means insuring Oracle's debt just got riskier and more expensive in the eyes of the market. And that can be one of those canary in the coal mine signals. Now let's take a look at how all of this is playing out across the big AI players. This chart shows the annual cost to insure $10 million of 5-year debt for Oracle, Meta, Amazon, and Microsoft. Now focus on for a second on that top line, which is Oracle. Since the summer, the price of protection has climbed sharply. Meanwhile, Meta, Amazon, and Microsoft, the lines in the middle and lower part of the chart, they have been much calmer, but they're also rising too. So credit investors are basically saying we're more worried about how Oracle is funding its AI push than we are about these other hyperscalers. But finding CDS data isn't always cheap or easy. So let's bring this back to something that you can actually see every day. Here in this next chart, we have Oracle's stock price in blue and the price of its long-term bonds in white, both since the beginning of the year. Now notice how they track each other pretty tightly and they tend to move in the same direction. And always remember that bond prices, which is what we're showing, move in the opposite direction of bonds yields, which is what we're not showing. So when the stock climbed through the spring and the summer, the bond price was generally moving higher too, which means that the yield on that bond was going lower, indicating less stress. And when the stock rolled over and quickly dropped after the September peak, the bond price also fell. That means the yield surged higher, and that indicates more stress. So even if you never look at a corporate bond or a CDS quote, a big persistent sell-off in a company's stock can be a sign that credit investors, they're getting nervous too. So here's what to watch out for from here. Oracle is less cash rich than the other hyperscalers, so that's our canary. So if you have access to Oracle's bond and CDS prices, you can see how they track with Oracle's stock price. And if you don't have that market access, know that any large or long prolonged sell-offs in Oracle stock is also a big warning in itself. Then, track how much new debt Oracle actually issues to fund AI data centers. That'll show up in headlines and earnings calls. Next, see if debt and insurance costs start rising for other AI hyperscalers. And if you don't have the data, you'll see the big moves in headlines or just watch for the big drops in stock prices. And finally, watch those hyperscaler earnings reports, particularly on AI and cloud profits versus their interest costs. We want to know if all those new data centers are earning enough cash to comfortably cover the interest bill. Bottom line, Wall Street is honing in on the great AI build-out tab, and now that they're paying attention, so can you. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
It's been a big week for the value retailers. Dollar General, Dollar Tree, and Five Below all reporting strong quarterly earnings as consumers continue to trade down. We're navigating how to play the sector with the Yahoo Finance Playbook. And joining me now, we got Anthony Jacumba, Managing Director and Consumer Sector Head at Loop Capital. Anthony, great to see you as always. Maybe start here, Anthony. We look at these names, these reports. Dollar General, Dollar Tree, Five Below. There are some viewers, Anthony, who, maybe they throw them all in the same bucket. Can you help us understand what are sort of the big points of differentiation between these names?
Yeah, I think that's a great question, a great place to start. So think of Dollar General as almost like a small supermarket, right? All three of them are small stores, by the way, but Dollar General, it's about 75-80% consumable. So think food, household cleaning items, health and beauty care items, whereas Dollar Tree is about 50% discretionary merchandise. So they have toys, they have party supplies, seasonal items, 50% consumables. And then Five Below is, the vast majority of what they sell is discretionary. And what's different with Five Below is that Five Below is really targeted towards a teen and a preteen customer. Now, one thing with Five Below is the vast majority of what they sell is $5 and below. With Dollar Tree, the vast majority of what they sell is $1.25. With Dollar General, they have a much larger mix of price points.
Anthony, when you look through these results, I'm curious, what was your takeaway about the state of the American consumer right now? How healthy, how resilient? We keep talking, Anthony, about that K-shaped economy. Is that what you're seeing in these results?
Yeah, we're definitely seeing that. There's no question about that. Now, look, the low-income consumer is holding in there. They're not doing great, but they're holding in there. High-income consumers are certainly doing quite well. Everyone in the middle is definitely trading down. They're definitely looking to stretch their dollar. And I think that we saw that in all three of these companies' results. And to some extent, that trade down more than offset any weakness that we saw with the low-income consumer.
Let's dig into some specific names here, Anthony. So Dollar General, that one surging today. This is an interesting stat you highlight here. Now pricing about 12% above Walmart on average, widest gap you've ever seen. How sustainable is that, Anthony?
Well, to be clear, I mean, that might have been a bit of an aberration. I mean, normally what we see is that they're about a mid-single digit percentage higher. So I don't want to read too much into one pricing study. And I will say, given the fact that they're just so much more convenient than Walmart, right? In other words, these stores are in your neighborhood. You don't have to drive 20, 30 minutes to get to the store. They're also 8,000, 9,000 square foot stores. It's not like navigating that 200,000 square foot Walmart. So they don't have to be at price parity with Walmart. They do have to be close enough for government work, as the kids say. And I'm not necessarily reading too much into one pricing study.
Why is that one a hold, Anthony? Is that a valuation call primarily?
You know, it's just real tough for me to get super excited about Dollar General. I mean, largely because I think, you know, if we were having this conversation a year and a half ago when Todd Vasos had just come back and there was clearly a lot that needed to be done in terms of the turnaround, I probably would have been more enthusiastic, but it looks like we're in the late stages of the turnaround. Now, having said that, there is still some room to go in terms of particularly inventory shrink and also damages. But it's just one of those ones where I really kind of feel like the turnaround is in the late innings, so it's tough for me to get super excited about it.
Let's switch gears, talk about Dollar Tree as well. You note they added 3 million customers over the past year, many of them making over $100,000. What does that customer mix indicate to you there, Anthony, if anything?
It's kind of where we started this conversation, right? I mean, folks are definitely looking to save money, and that's why you are seeing that trade down of those higher income consumers to Dollar Tree, and that certainly benefits Dollar Tree. There's no question about it.
What do you need to see to come off the sidelines on that one, Anthony? I mean, this one surged about 50% this year.
Yeah, so look, I mean, Dollar Tree, first off, they did sell Family Dollar, and that was definitely a major albatross for them. And they got $1 billion, which is about $1 billion more than a lot of folks thought they were going to get. Now, having said that, you know, when they reported results last quarter, they were just really, really messy, and the street doesn't like messy. This was a much cleaner quarter, so that was very encouraging to me. I also have to get more comfortable with the whole Dollar Tree Plus initiative, where they are selling more and more items above their single $1.25 price point. I am a little worried that they might take that a little bit too far and start to bump up against, you know, the Dollar Generals and the Family Dollars and the supermarkets, the convenience stores of the world. So that's definitely something I'm going to be looking for, in addition to just clean results like we saw this quarter.
All right, so hold on Dollar General, hold on Dollar Tree. Let's get to one you like. You're a fan of Five Below. I think you said here, Anthony, correct me if I have this wrong, I believe your favorite mid-cap growth idea. How come?
So a lot of it has to do with the fact that they brought in this new CEO late last year, Winnie Park. She is a merchant by nature, and their merchandising had gotten really, really tired, and she has definitely reinvigorated their merchandising. So they're focusing a lot more on newness. They are focusing a lot more on licensed products. So, you know, earlier this year, they really leaned into the Minecraft movie, Lilo and Stitch. More recently, they're really leaning into Wicked for Good. I think K-pop Demon Hunters is going to be huge for them. They did take some price, so they increased prices on 15 to 20% of their items. That helps them to offset the tariffs, and they still have a very long square footage growth runway. So, for example, last month they opened their first 8 stores in the Pacific Northwest, and those stores did incredibly well. So I do think, particularly relative to Dollar General and Dollar Tree, they just got a lot longer square footage growth runway.
Yeah, I mean, we're showing the chart there. What a move. I mean, the stock has surged about 50% this year, but you must think, Anthony, valuation still attractive here.
Yeah, the valuation is still reasonable. They're trading about, call it 26 times my fiscal 2026 EPS estimate. I think the best comps are more in the kind of 30 to 31 times range. And I think that my fiscal 2026 EPS estimate could ultimately prove to be conservative. So I do think that there's still some valuation upside in Five Below.
Anthony, we are always lucky to have you on the show. Thank you.
Anytime.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination. Over.